I'd like to welcome you to another one of our SKU Food Recipes for Success presented by FCC. And these are our opportunity at SKU Food to give back to food producers and processors in a very challenging year. And this week we're going to tackle a challenging topic, which is the numbers. And we're going to continue our series on the numbers where we're going to explore retail pricing. So we're going to talk a little bit about how retailers set prices and how suppliers, producers, and processors in the industry can really have some impact on retails, even though we know that it is ultimately the category manager's decision, but you can have some impact. So I'm going to show you how you can do that. And we're going to talk about gross margin, and which is interchangeable with the word category margin. So we're going to talk about that and talk about some of the numbers that the retailers have set for these targets. And then also we're going to talk about contribution, because I know when you add up the retail and the category margin that you see on your products, sometimes it can get very frustrating for suppliers. So I'm going to try to shed some light on that and help you understand what goes into it and also why it is what it is, so that you can see. And ultimately, for me, I find that it's better when I understand something, then I can either accept it and move on, and also try to influence it in certain ways. So that's what we're going to dive into today on our Recipes for Success. My name is Peter Chapman, and I've had the privilege, and it really is a privilege for me, working in the food industry for many years. Since I was actually in high school, I worked at a grocery store, never thinking that that was going to be my kind of career choice, but it's where I learned about the importance of dealing with consumers in the store, and also the complexity of the retail business, about getting a product to market and to the shelf, and ultimately getting it into the shopping cart. And so after I finished school, I worked with Loblaw companies for about 19 years. And it was a great opportunity for me to work with Canada's largest food retailer. And I don't necessarily subscribe to that Loblaw knows how to do everything, but it gave me so many insights into how retailers work and the processes required, and the different things that happen that make decisions, or where they're making decisions that ultimately affect the success or perhaps failure of certain products that are produced by our suppliers. So, and then since leaving Loblaw, I've had the opportunity, and I would say privilege again, to work with many suppliers and associations across the country, whether it was speaking at conferences, which unfortunately we can't do right now in the middle of COVID-19, but having the opportunity to interact and work with different associations, and trying to help their members see how the food industry can work better, and also working individually with clients and helping them develop their relationships with retailers. So what I try to do is take that experience that I have and bring that to you each week with our Recipe for Success, which is presented by FCC. And I'm sure that many of you are familiar with FCC and the work that they do in the Canadian food industry. And they've been involved in the agriculture, the primary production part of the food industry, for a number of years. And it's important for people to know that they really are working with clients from one end of the food value chain to the other. So they work with everybody from primary producers right through to processors, to suppliers to the food industry, which could be equipment manufacturers or different other people who are suppliers to the food industry, to wholesalers, distributors. So they really do understand our Canadian food industry. And I think that's a great asset that they bring to their clients. And their clients really are a diverse array of companies, right from artisanal producers up to multinational large companies exporting around the world. So they do have the expertise to help people in the Canadian food industry. So I'd certainly encourage you, if you're looking or needing some assistance on the financial side or other parts of your business, to contact FCC. And I've really appreciated the opportunity to work with them on our Recipes for Success project. So which we're doing every week. And we also invite you to send or suggest other topics for our Recipes for Success. We're looking at upcoming months right now and saying, what should we cover? So if there are topics that you see that would be relevant for your food business today, then by all means, I'd like to hear about them. Certainly some of the different themes that we've been doing different months are as a result of input from people who are on our sessions each week. And I see a note from Crystal there that she got her profit wheel So that's great. So for everybody who was with us last week, we made the commitment that we would send you one of our SKUFood profit wheels, and I have one right here on my desk because I use it often in my work, and it's a great tool, and I might even use it again today when we get talking about some of the different topics today. So Crystal, that's great. So you're welcome, and I hope you can put it to good use when you're working with some of your clients in Newfoundland and Labrador. I also want to remind you that I want our sessions to be interactive, so please use the chat function or the Q&A to ask questions. And these sessions are really meant to be for the people who are watching. And we work hard every week to put the content together to make sure it's relevant, but we don't know everything going on in your business. So if there are questions or comments or things that you'd like to know more about, then by all means, put that in there, and I will keep an eye on it as we go through our session today. So we really do encourage you to participate. And, you know, in my professional speaking work, I do a lot of reading about our industry, and obviously there've been a lot of people who've been really impacted by COVID-19 and the fact that there's no travel and there are very, very few events and that kind of thing. But one of the comments that I saw from a speaker in the UK, which I thought was very insightful, was that prior to all of the changes that the world has endured since March, as a professional speaker, when you're standing on stage, you really don't know what the audience are thinking. You're watching, you're looking, depending on how bright the lights are, you can see some and you can't see others. But it sometimes could be difficult to gauge what was going on or what was really on the mind of the people who are in the audience. And ultimately, our work is to make sure that we are doing the job for the people in the audience. And now with the ability online to communicate directly with the speaker through the chat function or Q&A, then you have the opportunity to ask questions. And it also helps me because then I know what's on your mind and I know the parts that I need to really focus on and perhaps spend a bit more time on than maybe I had planned, because it's important to you, the audience. So I think we all have to look for the opportunities in the new way of working, which many of us are. So, and also we do record our recipes for success each week, and we do send the recording out to those of you who've registered. And also sometimes we do send them out to our SKUFood list. We send the recording out just so that we can get as many people close to the content and learning from what we're doing on our recipes for success. So let's talk about retails. Let's talk about gross margin, category margin, and also let's talk about retailer profitability. So we're going to cover those different topics today in our session. And the first thing is to dive in and talk about the retails and retail pricing. And I certainly appreciate that for producers and processors in our industry, that retail prices are frustrating. You go in the store and you see the price on your product and you say, holy smokes, you know, I sold that to them for X and now they're selling it for X plus Y. They're making so much profit on my product and I'm not making nearly that much. So we're going to talk about that today, and we're going to talk about how they set those retail prices. One thing that you have to remember as a supplier, as a processor, is that you're really focused on your items. And I respect that. I know that that's what you have to make work, and it's your job to get your items in the shopping cart. But as a category manager, and sometimes when you're dealing with these things, it's very helpful to put yourself on the other side of the desk and try to understand what they're looking at. So if we look at their role, and if they are the category manager for pasta, you can see this is what they're looking at. They're looking at that whole breadth of shelving. There's, I think, about 32 feet of shelving. So 32 times 6 shelves. So that's like 200 linear feet of shelving that they're managing just in that one category. So probably hundreds of SKUs on there. So they have to make sure that the retail pricing works within the whole category. They don't just look at one item and say, is that price right? They need to make sure that the entire pasta category makes sense from a retail perspective. So let's just talk about that for a minute. And it's important to think and look at the category in segments, which is how they would do it. So we would expect, from looking at the way this category is set up, that the consumer will be coming down the aisle as you see it on your screen, from right to left. So they'll be shopping that aisle, and they want the consumer, most of them, I mean, they can't control everything, but They do put arrows on the floor now, which is also new. They didn't do that prior to March, but they would expect this, most of the shoppers would shop that, and they want them to see the higher end, the more premium items in the category first. So that's why they would put them right there. And also those items need to be priced to reflect their position, their sort of premium position in the category. So you can see in the red circle, there are some of the items from Berea and some other manufacturers that would be more the sort of, we'll call them premium products in that pasta category. So next in the flow, next the way that consumers are going to shop the category would be the private labels. So this is a Loblaw store, so you're going to see their President's Choice products, blue menu. So they're going to be next in the flow. And again, the retails of these products need to reflect what their position is in the category. They want the consumer to think of it as a premium, but they're going to price it lower than the national brand because they're going to try to entice people to buy it. That's what they do. So then the next segment of the category is probably where more of the volume is done, but it would be a lower cents per unit profit to the retailer. So these are mostly the Catelli SKUs in the pasta category. So they have a few more premium. So they have a whole wheat SKUs, they have some gluten-free SKUs, and then they just have their sort of blue box Catelli, I'll call it basic, and maybe that's not fair, but sort of the middle of the road within the pasta category. So again, those products would need to be priced, understanding where the premium ones are, understanding where the control label are, and within that pasta category. And finally, you see on the bottom shelf, there are a bunch of no-name SKUs and also probably more what we might refer to as value type offerings that are more focused on price, a little bit less on quality. And you can see bigger bags with probably better value per kg, that kind of thing. So all those retails, the category manager is looking at, and he or she are taking those and they're saying, okay, does that no-name 2-pound pasta make sense relative to the premium segment? So we can't just look at a retail in isolation. We have to look at it in terms of the whole category. Now let's just look at a little segment of the category. So we'll focus on that premium segment that I showed you at the beginning. And you can see when we look at the shelf that those Berea Farfalle SKUs are $2.49. And you can see right beside it is their President's Choice version. And they have a sort of a specialty line called Splendino in SKUs that are from Italy. And you can see that they're priced at $1.99. So what they're trying to do with their pricing strategy there is they're trying to get the consumer to look at the premium SKUs because they would know that Berea would be the premium SKU in the pasta category. But they also try to sell them that President's Choice SKU right beside it and go, hey, look, it's 50 cents cheaper. And from Loblaw's perspective, it may not be from Berea's perspective, but from Loblaw's perspective, they're saying this is the same product, but it's less expensive to you. So the category manager would be really looking at all that. And if we continue with that example, what we're going to do is we're going to pretend that we are Berea and that we're going to be trying to figure out where that SKU will get priced in the category when we go into to see the category manager. And these are the different things that a category manager are considering when it comes to retail pricing. So they're looking and they're saying, what are the objectives of setting the right retail? And the first thing is they have to understand what their category margin is. So in the pasta category, they could have a target, and we're going to look at that in the numbers in a minute, and I'll show you what a target could be for them in that category. And then also they're trying to maximize sales. I mean, they have to set retail prices that in their opinion, might not always be your opinion, but in their opinion are going to maximize the sales for that category, for that product. And they also have this category strategy, which they've spent some time and said, okay, we're going to have a premium product. We're going to have a medium level product. We're going to have some lower value end products. We're going to have control label. We might have some more expensive, really high-end premium products. We might have some products with specialty ingredients like gluten-free or whole wheat. So all those kind of things have to fit into that category strategy. And then they're going to take all that and they're going to try to do their work. And then the competitor across the street, which is another retailer, might go and put a price that's $1.79 when the category manager you're dealing with thinks that product should be $1.99. But if it's a product that they're matching because of their total format strategy, that changes everything within the category for retail pricing. So there are a lot of things that they are trying to consider when they're determining what is the right retail price. And it's not just the cost of goods. Certainly cost of goods impacts it, as we're going to look at the formula in a minute as to how they're going to calculate that retail, but it's a lot more than just the price. It's all these things that I've talked about that are impacting what that final retail price ends up being. And that's, going back to maximizing the sales, where does it fit within the category strategy, and also how is the competition priced, A, in the category, and B, on these SKUs. And as a supplier, you really should think through these things before you go to meet with the retailer. It's not just about thinking about all the things that go into what your cost of goods is. Yes, those are critical, and you have to end up with a cost of goods that's going to return a profit to your business. But when you take that cost of goods in, understand that's what's going to have a big determining factor on the retail. And that's why you have to understand the math, and you have to understand, where do you fit in the category? Are you a premium? Are you a middle of the road? Are you a value price product? All those kind of things. And also, where's the competition price compared to the retailer that you want to work with, that you've identified as the right place to sell your product? So all those kind of things impact that retail price. So let's just take a look and see how they're going to figure it out. So what they're going to do is they're going to take that formula that we covered last week when we talked about some of the numbers, and they're going to say, okay, the retail, I'm going to calculate that by taking my cost of goods. So that's what the supplier is going to sell the product to the retailer for, delivered price, remember, always delivered price, divided by 1 minus the gross margin, or 1 minus the category margin. So if we put some numbers in here, if we're going to say that our cost of goods on that pasta product is $1.75, so your delivered price to your customers is $1.75 per unit, then we're going to divide that by 1 minus 0.28. And so my estimate of the retailer's category margin or gross margin targets in that category is a 28% gross margin. So we're going to take our 175 product cost, and we're going to divide that by 0.72, and we're going to come to a retail that's $2.43. So you can see how that formula works. It's a not too complicated. You get through the algebra part of it, but it's taking that cost of goods, so $1.75 per unit is the delivered price, and we're going to divide that by 1 minus the category margin or the gross margin that the retailer is trying to achieve. And again, that's 175 divided by 0.72, and that gives us a retail price that, when we calculated, is $2.43. Now, $2.43 is what we would say on the retail side would be an ugly retail, and we don't think that people get too excited about that. And one thing that you would hear people inside the closed doors of a retailer say is that merchandising is art and science. And the science part is 243. The art part says, let's take it to 249, because we can get that extra 6 cents, and the consumer is not really going to care that much about it. So we're going to retail that product at 249. So that's how the retailer would arrive at that price. And then they take that 249 and they say, okay, based on everything else I've got going on in the category, does that retail price make sense? A, is it going to maximize the sales for that product? B, does it fit within my category strategy? So I can retail my President's Choice product for $1.99. So, okay, that's 50 cents less than the 249. That makes sense to me. And then if we go down and look and see the Catelli SKUs, they might be priced at $179 for an equivalent size. So you say, okay, they're a medium level product. The Berea is a premium product. Where $249 works with $1.79, or the Catelli might be $1.99, $229, different price points in there. But as long as the $249 makes sense sort of as a premium item in the category. And then they're going to look at all those value products, and they're going to say, based on the 2 kg bag of farfalle pasta from vendor ABC, if we look at this as only 500 grams, so if we multiply the four times the 2 kg bag, does it deliver value to the consumer? And those are all the kind of things that they're going to go through and say, does that really make sense for a retail? And if they do, and I'm sorry, the last thing they're going to look at is they're going to look at their competitive price checks. They're going to look at that and say, all right, where's the store across the street priced? Are they priced at $2.49? And if they are, okay, that's good. Another conventional store is priced at $2.49. Then they might look at the discount chains, and the discount might be priced lower, but that's okay. They do that. They say people are willing to pay a premium to shop conventional stores. So that's how they would look and set that retail price at $2.49. So you have to remember, as a supplier, what you can impact is you really can impact that $1.75 with your cost of goods. So you want to go into your customer with a cost of goods that's going to end up with pretty close to the right retail. Because if you go into your customer, say, with a $2 cost of goods, they're going to say, you know what, when I apply my 28% category of gross margin to it, the price point is too high. So if I get my SKUFood profit wheel and I say margin of profit at $2 with a 28% gross margin, that means the retail is going to end up being probably $2.79. And they may say, you know, that's just too expensive based on $1.99 for my control label and where Catelli's priced and that kind of thing. So that's where understanding that what you bring to the table for your cost of goods has an impact on what your cost of goods is, or sorry, what the retail will be. And so I do see there's a question here, and I'm just going to take a quick look at it. Is 28% an actual or hypothetical gross margin for pasta and the packaged food category? And the person here says they're asking for a friend. I'm not sure that I believe that. I think they're asking for themselves. So what I'm going to do, I will share some category margin percentages with you, because I think it's important that people understand these, and it's always important to know what that margin expectation is so that you can do this calculation in advance of your meeting with a customer. So so let's just look again and see that we're at 249. So also, if you are, sorry, I want to go back one. If you are a competitor to Berea and you see their product on the shelf at 249, you can also use that retail pricing formula to calculate what the cost of goods is. So if we just do the algebra and move that formula around, we can solve for the cost of goods. So if we know the retail and we know that category margin, and if you're already selling into that retailer, you definitely will know what that category margin is, then you can take the retail price and multiply that by 1 minus that category margin. So if we put the numbers in from the pasta, we can see that the retail price is $2.49, and understanding that, you know, the category margin target is 28%, then we just do $2.49, the retail, times 0.72, which is your 1 minus 0.28, and that gives you a cost of goods of $1.79, which, if you remember, is pretty close back to our $1.75 that we took at when we knew that we were Berea. So it's a way for you to use that formula when you go into the store to really try and understand some of your competitors' pricing in a category. Perhaps you're looking at getting into a new category and you want to just understand, like, what is the price, what is the costing, like what could we get if we were to sell something to a retailer. So you can use that that formula to calculate that for you. So before I get into some of the category margins, one of the things I wanted to address was MSRP, or manufacturer's suggested retail price. And this is something that is always a question that I'll get asked, you know, should we suggest our retail price? And you know, we know how it, we know the best price for it to sell at, and that kind of thing. And so when people ask me that question, I'll tell you yes, but no. So this is me giving you a little bit of an answer, I guess you could say, talk out of both sides of your face, or whatever kind of expression you want to use. But so should you have an MSRP? Yes, but no. So let me just explain a little bit about that. So when it comes to yes, yes, it's your product. You know, you should know how your product sells. You should know what the best retail is for your product in the market. And some of that could have been learned through direct selling as your business has grown, or perhaps you've got some opportunity in some places to have some input over the retail, but the reality is you should know your product better than anybody else. So yes, you should know what it should sell at. Doesn't matter whether it's in a specialty store or a conventional retailer or discount, you should have an idea of what the best retail price point is. And yes, you should, especially if you're selling into that specialty food channel, because those retailers will ask the question and they will say to you, what retail should we be? And you, if you understand what their category margin is, you should have an idea of what that right retail is for your product in that specialty channel. So yes, you should do the work. You should go through the exercise that we just went through to understand what that retail price point is, knowing what their category margin expectations are and what the competition is and that kind of thing. Because you can't suggest a retail that's not going to work for them. You have to suggest a retail that's going to be, you know, within sort of their world of possibility. So then to answer out of the other side of my mouth, I'll say, no, you don't control the retail. So one of the things you have to remember when you're dealing with a category manager is one of the last things that they actually do control after, you know, lots of different things sort of being taken and that kind of thing is they do control retail pricing. And it is their store, so they can price products however they want. So you don't go in and say, this is the price you need to be. So you let them control it or let them think that they control it. And no, you don't go into a large retailer and tell them this is how to sell your product. So these category managers, they should know what they're doing in their job. They should understand the category. So you don't go in and say, this is the price you need to be, because you won't have a very good result. And then I say no until you're asked. And a lot of category managers will ask you that question. They'll say, well, you know, what retail do you think we should be? And again, if you've done the work and you've had experience with your product and you know your product better than anybody else, then by all means, then you want to give them the right retail. But don't go in and tell them how to price your product. Don't go in and tell them what it should be. But when asked, then you definitely want to answer the question and have a well thought out answer to that question, because they'll respect you for that. And they'll say, okay, you understand my business. You've done your homework and that's, you're right. It should be priced at $249. Let's get it going. And that's the right price point. So I just want to take a quick pause to see if anybody does have any questions about retail pricing or MSRPs, anything else like that in terms of the pricing world, because retails are very important. It does have a big impact on your product. And no doubt your cost of goods is one factor in the category managers sort of decision making to get to a right retail, but it's not the only factor. So that's why it's important to look at all the other things that we've talked about, being the category margin and the competitive landscape and their category strategy, where you fit. All those kind of things are important to consider. So I don't see any questions. So we're going to continue, and we're going to talk about category margin and gross margin, that amount that you get frustrated about sometimes when you see sort of, we'll say, tacked on to your product. So let's look at gross margin, and what the retailer has to do is really factor in, they have a target and they have a number that they're trying to achieve for their either entire category. It can be an entire department. It depends on how the retailer is structured. And they've got to take all those different SKUs and meet or exceed their budget. And that's really what they're trying to do. They've been given a mandate that says your category margin or your gross margin. And it's important to know that those terms, and I think I mentioned it earlier, those terms are interchangeable when you work for a retailer. Their gross margin, their category margin, they think of that as the same thing. So they have this budget that they're trying to achieve, and they have hundreds, if not thousands, of SKUs that all have slightly different margins attached to them. But at the end of it, they've got to hit that category margin that they've been budgeted for. So it's not an easy task, and it's not a lot of room for them to kind of what we would call make investments, which means to have a lower margin on certain products. And yes, you can always make the argument that a lower margin, a lower retail with a lower margin might drive more sales and ultimately more dollars of profit, but retailers are really focused on those percentages. So you can't lose sight of how important that is in their world. And it's not to say that sometimes you couldn't argue and be correct, that you could deliver more dollars, but they are very focused on the percentages. So when they're developing the category margin or gross margin percentages for different departments, what they're looking for is they're saying, we need to price our products so that we deliver enough gross margin to cover our labor in that department. I've got to cover supplies. So depending on the department, if it's in a department like deli, for example, there could be a lot of supplies because you're backpacking certain products. Now, a lot more comes in pre-packed now, but there are certain products that still get backpacked or overwrapped, that kind of thing. Or if you think about the in the produce department, if they take a tub for a cord pineapple or something like that, those are all supplies that they have to pay for. And then also there's the ad investment. So there's the category margin, the gross margin that they're trying to achieve. And then they also are investing a certain amount of that in their ads every week. So that has to get paid for somewhere. And then also there's shrink. So if there's a certain percentage, and there always is, of products that do not go through the front end, through the cash register properly, or at all, if a consumer steals it or it gets broken, or there's lots of different reasons for shrink, but they have to charge enough to cover the shrink within that department. And ultimately, when you add that, when you take that category margin, gross margin, and you subtract those things, and it delivers what is called their department contribution. And that's what merchandising people are really trying to deliver. They're trying to set the right retails that are going to maximize sales and deliver that category margin, that gross margin that's going to cover labor, supplies, ad investment, shrink, and deliver what they call a contribution budget. And that's something that your category managers and the people that run the departments are measured on. And that's how sometimes they're incentivized. So it's always good to know, are the retailers, are your customers, are the people that you deal with, is that going to impact their bonus for the year? Because if it is, then my guidance to you would be that they'll probably manage to getting there. And I do see a question there from Ron, is stale date included in shrink or spoilage, produce, meat? Yes, for sure. Those items, anything, if it's a product that the best before date is expired, or if it's in a perishable department and it's not fit to sell, even if the best before date is further out, all of that would get included in shrink, yes. So, and those numbers, that's one of the things that always a retailer is trying to manage and reduce, because obviously it eats into their profit. And anytime a retailer can reduce shrink in their stores without sacrificing the shopping experience for consumers, then they see that as a win. And there are ways to reduce shrink. You can reduce your assortment. If you have 400 SKUs and you reduce that down to 350, you will bring your shrink number down at retail. But there may be some consumers who are looking for those 50 items that now you're not carrying, and they might go across the street. So it's always I guess what we would say is a balancing act to try and find really what is the right number for their target market. So I see another question there, just said, are large retailers likely to eat stale date, or do they expect the supplier to take it back? So it depends on the category and the relationship arrangement that you have with your retail customers. Now, most often a retailer and a supplier would agree on how many days of we would have to sell the product when we buy it. So if a retailer agrees with a supplier that any product they buy into their warehouse is going to have 6 months of shelf life on it, then as long as what has 6 months of shelf life gets accepted into the warehouse, then as the retailer, they look at that as, you know, we've got to move that product. Now, if product sales do not deliver within the time frame to be able to sell that product, then you would expect the phone is going to start to ring and your customers are going to start to say, hey, listen, you know, we bought that expecting, we both agreed that 6 months was enough time for that product to move through our system, and unfortunately it's not, and we're now having to eat that as shrink, and we're not going to do that for long. So at the beginning, they might accept a little bit of it, but ultimately they're not going to keep that product on the shelf if it doesn't turn. So really what it comes back to is that products have to sell to stay on the shelf. And you and your customers should agree on what that amount of time is that's reasonable for them to turn the product and move it. But if they start to run into stale date issues or code date issues, then they will start to complain about the product and either look for more time to sell it or look for an alternative within their store. So those are all the different things they're trying to achieve in terms of that category margin percent. And also, I see another question, so I'm just going to stop before I move on to the next slide. So it's, is this also applicable to distribution companies, or is it a different ballgame with distribution companies? The reality is distributors, although they perform a slightly different function, it should be the same. That relationship that you develop with a distributor, again, it should be that they have a certain amount of time to be able to move the product, and then their customers are going to want a certain amount of time, the retail side of things. So yes, usually that relationship would be the same between a supplier and a distributor, and a supplier and a retailer. So let's just look now, and we're going to continue looking, and I wanted to share some margin targets. So this goes back to one of the first questions that was answered. So are we going to talk about some of the gross margin, category margin targets that retailers would have? So what I've done is listed a bunch of them for you here, and this would be probably most likely in conventional stores, these numbers that I'm giving you here. So in a conventional produce department, retailers are probably trying to achieve a 45% shelf margin or gross margin. And in a discount banner, they would be likely to achieve less than 45%. And in a specialty store, they're probably trying to achieve a little more than 45%. And I'm going to show you how that gets sort of calculated or how they figure it out. But those are some estimates that I would give you. They're not cast in stone. They're not actual numbers from any retailer or anything like that. But if I was working with somebody and they came to me and they said, we want to develop an item for the meat department, I would tell you that the retailers are likely trying to achieve a 25% gross margin in conventional stores. Now, if your product is a boxed product, then they might be trying to achieve a little bit more. Fresh products a little bit less, that kind of thing. And it also depends on how impressionable your item is. If your item is a very impressionable item, then sometimes they might be forced to achieve a little less than what their category margin or gross margin target is. Whereas if you're more of a specialty product, they might be trying to earn a little bit more than what those targets are. So it's very important for people to know. And these are, again, fair questions that you can ask your customer and say, what is the category margin you're trying to achieve? I mean, you can figure it out when you sell products into them. But the reality is that for you to be doing your job as a supplier, these are the kind of numbers that you need to know. So, sorry, I was just looking, there's another question about same margin expectation for fresh meat or seafood as it would be for frozen. And the answer would be no. Sometimes they actually will try to achieve a higher margin on the boxed product or frozen product because it's the reality is that the retail pricing is a little bit more competitive on the fresh products, and that's what probably drives it down. So to make the department margin work out to say an average of 25, they try to get a little bit more on the other products, on the prepackaged products. So it's again, every retailer is different how they try to set up their gross margin targets, but these are some starting points for you if you are working within some of these different departments. And it's important to remember that the category margin, the gross margin targets are different depending on the type of format. So if we think of Sobeys, for example, and they have their Freshco stores, they would be trying to achieve certain margin or category margin targets in Freshco. And then if you think of Sobeys as being their conventional banner, it's likely that their gross margin targets in Sobeys in a comparable department would be higher at Sobeys stores. And the reality is they have more expensive costs to cover. A Sobeys store is more expensive to operate than a Freshco. The fixtures are more advanced, more elaborate, and they just have more staff in those stores. So, and that's really the whole philosophy of a discounter, is to have lower costs, which allows you to have lower gross margins and ultimately lower retail prices. And then if you think of the specialty stores in the Sobeys sort of stable of formats like Farm Boy, they would have probably the highest gross margin targets because they have great selection in say that produce department that we've been talking about. So they would offer a full assortment of SKUs, probably close to double the amount of different SKUs than you would find in Freshco in their discount banner. And there's a cost to that. So you have to have a higher gross margin target. So as you go from a discount to a conventional to a specialty store, the costs increase and so do the gross margin target. So it's important to remember that. So let's just take a look at that category margin. So let's say in a discount banner that they're looking for a 35% gross margin or category margin. They have an ad investment to cover shrink, labor, supplies, and that leaves them with that contribution number of around 15% for that department. And if we switch now to the conventional banner, so we've gone sort of from Freshco to Sobeys, for example, and again, these are not Sobeys numbers, I'm just using those as examples, they would probably be trying to achieve a 45% margin in their conventional stores. They have a slightly lower ad investment because they don't do discounts as deep. They would have a higher shrink because they have a bigger listing base, and they would have a higher labor number. So their contribution actually is a little bit lower in the conventional stores, even though they have a higher category margin or gross margin target. And then if we think of that specialty store, like say, for example, the Farm Boy, again, the gross margin is higher, the ad investment goes a little lower, the shrink goes up because they have an even bigger listing base and probably lower weekly volume on most items. So there could be a little bit extra shrink. They have more labor as a percent of sales, which could be maybe the same hours as in a conventional, like in a Sobeys store, but because the volume might be a little lower, it works out to a higher percent. And you can see what the contribution is quite close to the conventional. But it's always interesting for people to understand that really the retailers find that the discount stores sometimes can be more profitable to them than say the conventional stores, even though the pricing is lower. And then when you factor in increased volume, then you know that it really does deliver more dollars to their bottom line in the discount banners. So before we move to contribution and profit, I'm just going to look, because I do see we have one more question here. For convenience stores, expect suppliers to pay refrigeration. So yes, retailers are very good at finding ways to charge suppliers. And it's important that as a supplier, you understand what are the costs of doing business with each retailer. They're all different. They all figure out how to charge things, whether it's a listing fee. So the question is the same thing with grocery stores, is it built into their markup? So most major retailers don't charge you that type of refrigeration or that kind of a fee as a convenience store. But they do have different ways of recouping that money from you. Sometimes they charge a warehouse fee, and they do have listing fees that Ron mentions in his question here as well. So there are all kinds of different ways that retailers try to extract money from suppliers, and it really is important. And actually this morning, just by coincidence, I was on a call with somebody and going through understanding what are the costs of doing business with different retailers, and they all have a different way of doing it. So you have to make sure you understand their particular model, so you know that you do know all of the fees. So let's just talk about contribution, and this is how the retailer derives their profit. So they take that department contribution that we just discussed, and then they have more costs that they have to cover. And the reality is they have an overhead of running their business. They've got that big fancy office, and they've got people working in a lot of parts of their business that can't get allocated specifically to produce or grocery or that kind of thing. They also have distribution, and that's a big cost to them, the big warehouse and moving product all over. So that's a big number that they have to absorb. They also have those other fixed and variable expenses in their business that we all have in our businesses, and they have taxes and those kind of things. So ultimately they're trying to get to that profit number. So let's just take a look at that sort of contribution for a retailer. And what I'm going to do is now we're going to move to the total store. So departments get managed by department. And then when it comes to this level of the numbers within a retailer, it really gets managed by the total store, by the total business. So on average, we're going to say in a discount store that the margin, the gross margin, the category margin is going to come out at a melded number of 25%. And remember, grocery is more than 50% of their sales. So if it's at 20, that really brings that number down, even though we see a higher number in some of the fresh departments. So that melded margin number across the store is 25. Overall, the ad investment is about 6.5. They have a 1.5% shrink. They have labor of 6%. So they have a total contribution number of 11%. And then when you look at what else it costs them to run their business, they have overhead, fixed and variable expenses. They have a distribution charge. And so those other expenses add up to about 9%. And you can see at the end, they're left with about a 2% profit at the end of it. And that's really, if you look at the big retailers, the large retailers, that's really what level they have to work with. So that's why when it comes to saying, should my product, you know, if you go in and you want to try to sell your product on the shelf for $2.29 and they want to be $2.49, well, that can be the difference of that 2%. And no, your sales are not going to have a material impact on a, you know, a 20 or $30 billion business. But if they keep doing that across different categories, then they're not going to get their 2%. And that's why they have to manage to those margin numbers so carefully to achieve the targets. And I know we have another question. I'm just going to cover the discount store here so that we can see that, and then I'll show you what a conventional store looks like. So you can see that the melded margin across the store goes up to about 30%. Then you see the ad investment is a little bit lower. The shrink is higher because they have a bigger listing base to absorb shrink on, and then the labor number is higher. So overall contribution in a conventional store plus or minus 12.5. And then you can see they get charged usually within the retailers. The conventional stores get charged higher numbers for things like overhead, fixed and variable expenses, and sometimes even distribution, because they are more expensive to operate. Then the people who run the discount part of the business would say, well, hey, we don't need all that fancy stuff, so you can't charge us for everything. And so oftentimes there's that kind of internal debate about who gets charged what. But at the end of it, usually the profit in these sort of conventional stores can be even a little bit lower than the discount. So you can see I've got 1.5. And again, these are estimates, but it does give you a sense of how the profitability and why it's so important that the work is done up front. Because for a retailer, they can manage costs, which there should be very focused on. And that's why a lot of times you see some of these fees that they come at us with for distribution and warehouse and late deliveries and all these things, because they're looking and saying, there's a cost to that, and I'm gonna put that cost back on the supplier if they don't do their part to meet their obligations. And whether we like it or not, that is the way that often they will operate their businesses. So I'm just gonna check, I see we have another question here, so I'm gonna take a look. So the question is, how much should the retailer charge the supplier? How much margin as a supplier can have through the retail channel? So as I said, that really is a question that's unique for each retailer. So most often when you want to have your products carried in one of the large retailers, they will charge you upfront a listing fee. So that's kind of the first fee that you need to understand or figure out how to absorb in your business. And then after that, they're going to charge you, sometimes they'll charge you a warehouse fee. They will also charge, sometimes there are other fees, they'll call them. They have different names for them, but they will charge you different fees. So there's different cost structures the way that they do it. So that's why it's so important to really understand what are they looking for. And then they're also going to be looking for you to invest on the trade spend side. So they're going to be looking for you to lower your price to them, maybe 3 or 4 times a year for in-store specials or loyalty program or different opportunities where the price can be lowered on the shelf. So it's important to understand what those fees are, because they ultimately for you and your business, that has to be covered on that markup side that we talked about last week, where you really need to take your cost of production, mark it up, and you're going to have to cover those things that the retailer is going to charge you. So I see that we have another question. It says, are retail brands with several market position stores, for instance, No Frills versus independent versus conventional stores, operate as separate companies, or do they share costs and resources such as trucking, warehouses, admin? So retailers that do have a number of formats would try their best to share distribution and share some of the other costs like admin or human resources or some of that part of their business. But as I said, when I was looking at the different contribution models for conventional versus say discount, the discount segments or formats within the business would always be pushing to say, hey, you need to charge us less because we're less expensive to operate. And that's always a debate, an internal debate within the retailers, is to say, you know, how much do we need as far as support for our stores? And everything is a cost that they have to cover. So if they're going to have chefs in their community rooms, for example, well, the discount stores don't have that. So the conventional stores have to charge more or get allocated more to operate those programs because they do offer it as a service to consumers. So they do share those centralized services, they call them, but always the people running the discount part of the business would always want to get allocated less because they feel that that it's lower to operate that part of their business. So I'm just going to check. I see one more question here. I see a comment from Jim there saying that he appreciates the info, and you know, it's true. There are so many things and to being a successful supplier, and one of the things which I always would include when I have the privilege of speaking to groups, whether it's online or live, hopefully soon in the same room at some point, that success in this industry is not just about making great products to sell. It's about selling the great products you make. And selling the great products you make is all about understanding all these numbers and really being able to position your product properly within the category so it has the greatest chance of success. And as a supplier, you can influence a lot of that. So it's important for you to know how these things happen and how the retailers do calculate them. So that is all part of selling those great products that you're producing, and it all makes a difference, and it's important to understand it all. So I hope that today we were able to shed some light on how retailers do set retail pricing, how you can influence that, and then also how these category gross margins get set and how the retailer generates the profitability that's in their business. And so next time you look at the financial numbers from one of your customers, you can have a greater sense of how it gets derived. It doesn't mean you need to like $1 billion profit at a company like Loblaw, but remember that in a $40 billion business, $1 billion bottom line is really like a 2% or just over 2% bottom line. So they do have to manage those margins very carefully to determine that, to deliver that profit within their business. So as we do every week, I wanted to share some good news as well in the food industry. I think that we've come through our Canadian Thanksgiving in the last week, and we saw different things happening in the market. So I just wanted to share some things that we were able to find. So this happened a little bit earlier in the year, but I think it's worth noting that HelloFresh, the meal kit company, donated $40,000 to food banks across Canada, and they selected 4 food banks in different markets to donate $10,000 each to help those food banks with their ongoing operating and deliver food to Canadians in a time when they're very challenged to be able sometimes to put food on their plate at home. So a nice initiative from HelloFresh and being part of the Canadian food industry. And also last week, I'm sure many of you would have seen an announcement from the federal government that there would be another $100 million allocated through the Emergency Food Security Fund to food banks and related associations across Canada to try and help them provide food to Canadians. So hopefully some of that money will be invested to also purchase some of the food. I think we have to be realistic about where food comes from and that there is a cost of producing and supplying food to Canadians, and that these when these things get developed, that also that there is that sort of voice at the table that says we also have to make sure that part of it's going to come from donations from consumers, which is phenomenal, but also that if we are going out and procuring food, like you can see here, this is a photo of the Ottawa Food Bank. So those are full pallets of product. That's not donated by a consumer. That's either purchased or in partnership with producers and processors. So we have to make sure that we have enough there that producers and processors are included in this equation because they have costs that they have to cover in their work. So, but it is important, and we know as in many parts of the country, we're dealing with this second wave where we're going to see even more and more people impacted, and really have to unfortunately, more people in Canada depending on food banks. So it was good to see that people are recognizing this, and hopefully it will be recognized throughout the entire value chain. And then finally, on a little bit different tack, this is something from Nature Fresh Farms, and I'm sure, hopefully, you've seen where they introduced their compostable English cucumber sleeves. So I think this is something that, as we saw the announcement last week about plastics, and that's something that as suppliers we really need to be in tune with, is where things are being mandated on plastic and that whole recyclable, compostable issue. But Nature Fresh introduced their compostable sleeves on English cucumbers, and I think it was a really interesting piece that led them to this, and also talked about 2 years of research and development, and their 100% compostable cucumber wrap, which in their words is a first in the North American market. It's made from a starch-based PLA, derived from plant-based sources, and it's compostable, breaking down naturally into CO2 and water within 90 days. So certainly an improvement over the traditional plastic sleeve. And we do have to protect those English cucumbers as they work their way through the supply chain. So congratulations to Nature Fresh. But as part of that, what I thought was so interesting as well is that they're making the commitment to plant 25,000 trees as part of a sustainability campaign. So it's one thing to say, hey, we're doing this, we're putting a compostable package on our English cucumbers, but they're going another step. And what they're doing is they're wanting to celebrate this with customers and consumers. And so this marketing program, so it kicks off with social media, Instagram, Facebook, and LinkedIn. And there's that LinkedIn thing, talking to their customers, not just consumers. Remember, we talked about that, how important that is. So every time someone shares one of their posts on social media, so this is a way for them to get the word out. Every time somebody shares one of their posts during October, they will plant a tree. And what they're hoping is that they're going to get a total of 25,000 shares during the month of October. So you can imagine how much of a reach that will provide to their program about compostable sleeves. So I thought it was a really interesting marketing tactic for them, for Nature Fresh to embark on. It's a Canadian greenhouse company in Ontario. So I was really interested in that. I thought that it's something that is a really interesting idea, and a way for them to get the word out and promote what they're doing in a positive way, and reward and for consumers for sharing their information with their own network. So I thought that was a really interesting opportunity to share with you. And I see a comment from Ron about my quote that success in the business is not just about making great products to sell, but selling the great products you make. So I'm glad that he wants to share that with his sales team. And yes, that is a quote that I put my name beside on a lot of materials as well, because I think it's important, and it is about making great products, but also about selling the great products you make. So thanks for that note, Ron. Appreciate it. And Al, I appreciate your comments as well. And hopefully next week you'll be able to join us. We have another one of our SKUFood Recipes for Success presented by FCC, and we're going to talk about temporary price reductions. So how much should you reduce your product, and how many do you have to sell to make it back, and those kind of things, because we know, and if you listen to AC Nielsen, they would tell you that over a third of the products in our Canadian food industry are sold with a temporary price reduction. So how are you going to factor that in to your cost of goods? And it's an important part of understanding the numbers, and really being an expert at selling the great products you make. So so Laura, I see your, or Lana, sorry, I see your comment. Thanks very much. Jim, we always appreciate people putting comments. It's great to hear from everybody, and know that you're out there as well, as I share these insights each week with our Recipes for Success presented by FCC. So we really hope you can join us next week. If you go to SKUFood.com, you can register if you're not already registered. And as I always tell you, if you have any questions or comments, by all means, let us know. And I actually think I have a couple of emails from last week that I need to get back to people on after being away for Thanksgiving weekend. So thanks again for being here. Always appreciate and understand your time is valuable. And we look forward to seeing you again next week on our SKU Food Recipes for Success presented by FCC.